Hello everyone, welcome to you on Think Future Academy channel. Today I will cover the budget types, process and methods of videos on budget and cost management skills. This is continuation to my last video of chapter 1, where we understand the definition of budgeting, dimension of high-level budgeting strategy, CapEx and OpEx budget types. Today we are going to learn the segments of budget which is called operating and capital. It is also part of CapEx and OpEx. We will learn now in broader term. A solid budget framework is developed around a master budget that includes operational, capital expenditure, and cash budgets. The budgeted income statement, balance sheet, and cash flow statement are produced by the combined budgets. Budget. A business budget is a spending plan for your business based on your income and expenses. It identifies your available capital, estimates your spending, and helps you predict revenue. A budget can help you plan your business activities and can act as a yardstick for setting up financial goals. Operating budget, also known as OpEx. An operating budget is a detailed projection of what a company expects its revenue and expenses will be over a period of time. Companies usually formulate an operating budget near the end of the year to show expected activity during the following year. Capital budget is also known as CapEx. A capital budget is a long-term plan that outlines the financial demands of an investment, development, or major purchase. As opposed to an operational budget that tracks revenue and expenses, a capital budget must be prepared to analyze whether or not the long-term endeavor will be profitable. Budgeting process. There is probably no one right way to create a business budget. But to guide you through the process, here are 9 important steps to follow. Budgeting process enable the organization to set the clear targets, expectations and priorities tangibly. It connects the finance team with the stakeholders of the business to integrate the process required. The diagram desync to show you the generic flow of budgeting with CR 9 steps as follows. Step 1. Review the previous period. Step 2. Calculate existing revenue and expenses. Step 3. Set out costs, fixed and variables. Step 4. Forecast and scrutinize cash flow. Step 5. Business decision making, plans. Step 6. Communicate clearly with all stakeholders and management. Step 7. Changes in budget model and review. Step 8. Approval of budget. Step 9. Implementation and control. Budgeting methods. Companies often utilize one of 4 types of budgets: incremental, activity-based, value proposition-based, or zero-based. Each of these 4 budgeting techniques has benefits and drawbacks, which will be covered in greater detail here. These 4 budgeting methods are: incremental. Number 2. Activity-based. Number 3. Value proposition. And number 4. Zero-based. Now we will understand the incremental budget first. There are 4 dimensions to consider when translating high-level strategy, such as inefficiencies. Inefficiencies are likely to persist. For example, if a manager knows that he can increase his budget by 10% every year, he will simply take advantage of the chance to increase his budget without making any attempt to cut costs or economize. Budgetary slack. That will almost certainly result in budgetary slack. For example, a manager may overestimate the size of the budget that the team truly requires, giving the impression that the team is consistently under budget. Disregard performance. It is also prone to disregard exogenous factors of activity and performance. Some input costs, for example, have seen very substantial inflation. Incremental planning ignores all external considerations and just expects that costs will rise by 10% this year. Number 2. Activity-based. Activity-based budgeting is a top-down budgeting method that identifies the quantity of inputs needed to support the company's aims or outputs. For example, suppose a corporation sets a revenue target of $100 million. The firm must first define the actions that must be carried out in order to accomplish the sales objective, and then evaluate the expenses of carrying out these operations. The below diagram start from activities and then cost expectations and result is output. Number 3, value proposition. In value proposition budgeting, the budget coordinators considers the following questions. Why is this amount included in the budget? Does the item create value for customers, staff, or other stakeholders? Does the value of the item outweigh its cost? If not, then is there another reason why the cost is justified? Value proposition budgeting is basically a mentality about ensuring that everything in the budget adds value to the organization. Although not as accurate as our last budgeting option, zero-based budgeting, value proposition budgeting seeks to eliminate wasteful expenses. Number 3, value proposition. Zero-based budgeting, one of the most popular budgeting systems, begins with the idea that all department budgets are zero and must be established from beginning. Management must be able to justify each and every spending. There are no automatic okayed expenses. The goal of zero-based budgeting is to eliminate any and all expenses that are not regarded absolutely necessary to the company's effective, profitable, operation. This type of bottom-up budgeting can be a highly effective approach to shake things up. The zero-based strategy is useful when there is an urgent need for cost reduction, such as when a firm is going through a financial reorganization or a big economic or market slump that necessitates it to drastically lower its budget. Zero-based budgeting is best suited for managing non-essential running expenditures rather than discretionary spending. Yet, because it is a time-consuming strategy, many businesses only utilize it on occasion. In the next video, I will cover budgeting approaches.
I hope you enjoyed this video, and before leaving, if you have not already subscribed this channel, make sure to subscribe, like and hit the bell icon to get updates when I post new videos. Provide your feedback in comments. You can download material from the below links under video.